Alright, so you hear the talk about Roth IRAs and traditional IRAs, right? And I'm not going to go over the tax advantages, but when I hear financial advisors talk, they're only talking about the tax advantage. None of them are talking about the time advantage of one or the other, okay? And in my opinion, I think that it's important to have a tiny bit of your portfolio going into a traditional IRA just in case you're forced to invest in a traditional either IRA or 401k later on. And let me explain why. So let's just say that you work in your 20s and 30s, and for whatever reason, maybe you're working for a small company, maybe it's for a mom and pop restaurant, whatever, and maybe you decide in your late 30s, to go to school, whatever, maybe you don't work for a big firm until you're in your late 40s. Okay, in that case, if you go with a traditional 401k or traditional IRA, and you've been putting all your investments in a Roth, you haven't put anything in a traditional account, you're going to get hit at 70 and a half with what's called required minimum distribution. So take this for example. I have $6,000. Let's just say you maxed it out. You're no longer eligible for a Roth, or you put that in a 401k plan, whatever, either a traditional IRA or traditional 401k, and everything else before was all in Roth. Okay, IRA or 401k doesn't matter. It's in Roth. It's in a Roth account. Okay, well, in 20 years, you're only going to get 6.458%. Now, we're in low interest times when a lot of people can get interest rates under 5%, but over the long haul, there's a good chance that interest rates are going to go higher. There's a good chance that CDs could maybe even go above 5%. That's barely going to beat a cash account over a long haul, okay? And now you're forced to take a required minimum distribution out of here, where this might not be the most efficient way, even though at the time when you invested it was the most tax efficient way. That doesn't mean it's the most efficient way overall. So if you have, say, $100,000, $500,000 in Roth, that's been sitting there from your 20s and 30s, and you're 70 and a half, or maybe it's been sitting there since your 40s or whatever, you still got a 30 plus year time of compounding. That's going to be more efficient. Let me just show you this. Let me back up another 10 years. So we have 6.458% per year is the annual average return, right? That's the rate of return per year. You get it to 30 years, and all of a sudden it's 9.077%. Okay? Let's go back to 1974. We had a big crash in 1974. So that would actually be the ending year. So I'm going to pick 1974 right there, and I'm going to go back 30 years. So 30 years would be in the 1940s, 1944. Okay, and we're going to see just how much that, see, that was a bad year for the stock market as well. And look at this, it still gives you, with dividends reinvested, it's still over 9%. And there was a 49% crash that year. So if you give yourself enough time to invest for the dollar cost averaging to kick in, the dividends to kick in, over a 30-year time frame, that will cover you over a long period of time. So I guess what I'm saying is to protect yourself from selling assets that have only been sitting in there for less than 20 years. put a little bit of money into a traditional IRA. If you max it out, say maybe do $1,000 if you're going to max it out. Say you only have $1,000 to invest for the whole year. Okay, so put $100 in a traditional IRA, put $900 in a Roth IRA. Just make sure that you put enough in there so that when required minimum distribution time hits, you're not pulling that money out that hasn't been sitting there very long. You might get forced to sell those assets by the IRS at the wrong time. As long as you give yourself time, then it doesn't really make much difference where you land on 30 years from now. It matters tremendously when you shorten the amount of time that you have for that money to stay in there. Okay? So again, if you're younger, yes, traditional IRA makes sense, but make sure you have some tax deferred, whether it's a 401. If you have a 401k, you're already good. If you don't have any company plan, then put it into a tax deferred traditional IRA, just a tiny bit of it, so that you don't get hit with that required minimum distribution before you actually want to pull it out.